questions about anything we looked at so far today? Anything from this morning that we need to have a second look at? And I think there's a couple folks on the call who came on late. We had a fairly in-depth discussion about the exam this morning and all that goes along with that. Okay. All right. If there's no questions, then I'm going to go on to my next thing. And this is the, sorry, I'm having a problem admitting people from the waiting room here. All right, there we go. So this is the annuity I talked about before. Now we're really going to talk about annuities in chapter 14 in more detail, but just briefly here, it is possible, as we heard this morning, one of the three options, I think Grant or Paul, I can't remember who brought it up, but on maturity of an RRSP, or once you have a RIF, you can buy an annuity. And this is what we would refer to as a registered annuity. So it just means that it's purchased with registered money. Okay. And the basic idea here, it's really a time value of money problem. So let's say that I have somebody who is age 75 and has $300,000 in an RRSP, or sorry, in a RIF, okay, and decides to buy an annuity. Okay, well, what you're going to get here, this money is all registered money. So now you're going to get an income, assuming it's a life annuity, which is most common here. You could do a term certain annuity, which would only pay for a term. You're going to get a life annuity here. It's going to pay somewhere around $22,000 a year, thereabouts, for life. Okay, and the full $22,000 is taxable. Okay, and that's it. It's just ordinary income. There's nothing fancy about it. Now, to the point, I can't remember who raised the point before the break, maybe again, Paul, but that income would qualify for the pension income tax credit because it's a withdrawal from a registered plan over the age of 65. Okay, that's good. And that's really all you have to know about registered annuities. They are simple, okay? Every dollar that comes out is taxable. All right, any questions there? And like I said, we'll talk about annuities and annuity planning more in chapter 14. I just want to cover that off here. Okay, perfect. Now, one of my, I don't know, it's something that we have to teach. It's a common enough question. I have mixed feelings about this whole thing. And in fact, I'm generally not a fan of naming our financial strategies after large-scale disasters, but here we go. So what is often called the RSP meltdown, you might, if you want to have a better name for it, maybe call it the drawdown, but it normally is called the meltdown. And what happens in an RSP meltdown, let's say I have somebody whose age, I don't know, let's go 62, and has $2 million in an RRSP, okay? This person is still working, and they have this concern where they say, look, if I keep building my RRSP, okay, I could retire with a maybe a $3 million RIF, okay? And the problem with a $3 million RIF is if we take our minimum withdrawals, you take your 5%-ish minimum, it's $150,000 of income, you're in a fairly high tax bracket. Okay, is everybody with me there? Everybody understands that at least the gist of the problem here? you're going to lose, you're going to have full OAS clawback, all that good stuff. Okay. So what some people will do, and I am not recommending this, I want to be perfectly clear, this is not a recommendation. It might be appropriate in some circumstances. What we're going to do here is separate from the RRSP, we're going to have our client borrow as much as they're comfortable with in order to invest on a non-registered basis. So let's say that this person borrows, I'm going to have them borrow $1 million to invest on a non-registered basis. Okay. And they qualify for that. They earn good income, so they can borrow that $1 million. They're going to go and buy mutual funds or whatever the case is with it. Are we good there? And now they're going to have to pay interest on that. So they're going to have, let's say, for the sake of argument here, we're going to have about a 4% annual interest expense. Might be a little high, but somewhere around 4%. 100% true grant, cannot use a TFSA here. So you're going to have $40,000 of interest needed. Now, what's the sort of notable tax feature of that $40,000 of interest? What's notable about that 40,000? Yeah, that's exactly it, Sean. That's deductible, right? That's a deductible expense. Okay, so here's the challenge. I need $40,000 to cover this debt. I don't have the $40,000 just laying around. However, where could I take the $40,000 from? So that's what I'm going to do here. To pay the interest, I'm going to do as Sean suggests. I'm going to make a, or sorry, as Paul suggests, I'm going to make a $40,000 withdrawal from my RRSP. Okay, now what happens when I make that $40,000 withdrawal? That's taxable as income. Okay, if I have a $40,000 source of income and a $40,000 deduction, what's my net effect? What's my net here? No tax, Melanie, right? So the net effect here is that these two offset and we don't pay any tax, exactly as Melanie indicates. Okay, that's good. And so the result here is going to be something like this. You're basically taking some or all of the growth from your RRSP to cover off that interest expense. And now you're getting growth in this non-reg account. Okay, so maybe you do something like this. We fast forward to age 75. And maybe here you've got, what should we be at then? Something like, let's call it $1.9 million in the account. You pay off the $1 million loan at that point, and you're left with $900,000 of non-reg money, which is not going to cause you the same tax problem. So the idea here is you're sort of affecting this long-term swap of registered assets for non-registered assets. Does that make sense? Yeah, you absolutely could use corporate class funds here, Grant. Yeah, so you could use tax-deferred funds. They generally do qualify as investments for the purpose of that tax deduction. Okay, the rule is that the underlying investment has to be able to pay dividends, not that it does pay dividends. And a corporate class fund can pay dividends, and some of them periodically do, right? It's not, don't worry about the million, Bev. Okay, that's not, I could have made it a million, whatever. I just assumed some growth here. You see, we could have done all kinds of time value of money here. We could have done an Excel spreadsheet. But really, it's that I moved some of my investments from, I did, Mike, I absolutely did withdraw the 40,000 a year. That's what I have in black on the top right there. Okay. Okay. I'm not sorry, Bev. I don't know if you want to come off mute here and ask me your question. I don't know if we're thinking about the same thing here. Okay.
I guess I'm just wondering, it's $1 million. He just has $1 million, like not in his RSP then.
Oh, he borrowed the $1 million, or she borrowed the $1 million.
Okay, you borrowed it, so you didn't take it out of this 2 million RSP. Okay.
Right. See, in red, the second line there says borrows. So you're not borrowing it from the RSP. You can't do that, right? You have to go to
That's what I was thinking. You couldn't do that. Okay.
Yes. You have to go to your financial institution, set up a loan for it.
Like a leverage.
Okay. So yes, remember I made this exact comment, Robert, way back when we talked about leverage in general, that leverage always looks good on an Excel spreadsheet, right? Remember that comment? Everybody is always going to come out ahead using leverage. The reality, though, is I'm exposing this person to a fairly substantial amount of risk by employing this strategy, right? So I've got a short time horizon here. It's only, maybe 10 to 20 years of time horizon, which might be okay. Okay, I would suggest that's long enough for some degree of equity investing. However, the challenge here is if you get a bad year in any of the last 5, you might not be able to pay off your loan. So that would be my sort of biggest concern, is around timing of my investment returns. And I know I'm going to get bad years in there, right? And 20 years of investing, I'm going to have bad years. And yeah, it's true, Paul, you're right. I am using that person's creditworthiness. So it sort of, whatever, deploys or depletes their creditworthiness. They're not going to be able to borrow money for other purposes like a business or a vacation property or whatever you have. Okay. Yeah, so Grant, we're going to talk about IFA in chapter 3 of advanced curriculum. IFA, for those that don't know, it actually relates to the question. I can't remember who asked the question this morning, but it's a immediate finance arrangement. It's an arrangement in which you take out a life insurance policy, you pay the premiums on it very quickly, and you borrow the cash value essentially as much as possible in the first year and then on. So, okay, but we won't do IFA just yet, Grant. It's quite complicated. There's a lot we have to learn before we can learn IFA. All right, so it's going to, yes, deplete their creditworthiness. And you just run the risk. What if there's a health problem early? Or some other event that's outside of your control? We get messiness. Some worst case scenarios here too is if you have a separation, marital breakdown, which happens in this age group. It's not something that folks are immune to beyond a certain age. So if you have a separation, the investment and loan get messy. Okay. Okay, that's good. So, Robert, you're exactly right. This always looks great on paper. And then when we start to have real people really borrowing $1 million or whatever the case is, it gets messy. And I would suggest, how big a problem is it having $150,000 a year of income? Okay. If I went on Twitter today and I tweeted, I've got this giant problem, I'm going to make $150,000 this year, how would that turn out for me? Okay. So sometimes a little perspective might be helpful here too. Okay. That's all good? All right, perfect. Okay, we're going to switch gears here. We're going to look at the deferred profit sharing plan, which has a lot of overlap with the RRSP. However, is not an RRSP. It actually predates the RRSP. It predates the RRSP by 4 years. And in a deferred profit sharing plan, I have, and some of the rules are different than they've been in the past. I'm going to do the today rules. There's been a fair bit of change to this plan over the years. What I have here, I have an employer-sponsored retirement plan, and only the employer can contribute. There are no employee contributions. Okay, the employer must be a for-profit company. So you can't do this in the charitable sector, for example, or for a nonprofit. And the owners, if you own 10% or more of the shares, you cannot participate. Okay, but what's going to happen here is then the employer contributes to the plan on behalf of the employees. Okay. Just like with an RRSP, we're going to have some tax deferred growth. You have a range of investment options. This is where you're going to do this with a group retirement services provider. So for example, you'll use whatever, Mackenzie's group retirement services or Sun Life's group retirement services, and they have a range of investment options they'll give you. They'll choose some equity stuff, some fixed income stuff, some balanced. Yeah, so they can do that, Robert. That's fine. It's the DPSP specifically that the employer, the owner really cannot participate in. Okay. Yeah, because there's a little bit of opportunity for manipulation here, Robert. It's actually pretty common to hold shares of the sponsoring company in the DPSP. Okay. And there's an opportunity to swap those shares later on. So yeah, we don't want that type of sort of manipulation happening here. And then the other is, it's profit sharing. You see that right in the name, it's a profit sharing plan. That's good. So just conceptually, the owners of the business already get the profits, right? That's what dividends are for. You with me there? So to profit share with yourself, just conceptually does not make sense. You can't profit share with yourself. Okay. Yeah, so exactly right, Paul. Right, there you go, Stephen, right? Okay, so yeah, exactly that. So when the employer contributes, those are tax deductible for the employer, and they are tax-free to the employee. Okay, so the employee doesn't pay any tax on those contributions. Instead, we're going to give them a pension adjustment, just like we talked about before. What happens when you have a pension adjustment? What's the consequence of a PA? That's it. It's a loss of RSP room. Okay. That all makes sense? And then what normally happens here, the normal outcome, is that when the employee leaves, so for whatever reason, termination or retirement or whatever the case is, they are quite common actually, Mark. Yeah, and you do actually know people who have these, okay? They just don't know that they have them. All right, but this is actually quite common, and I'll show you exactly where you see these. So when the employee leaves, they normally just transfer the funds to their RRSP. Okay, and they've already used the room, so there's no room required here. It's just a transfer of one kind of registered account to another kind of registered account. Does that make sense? And the plan must be collapsed, that is transferred to an RSP or RIF by December 31st. Oh, there you go, Tricia, right? By December 31st of the 71st year. Okay. So that's really what you're looking at with DPSP. It's essentially the same as an RRSP with the restrictions that I showed in black on the top left, okay? Where the owners of the company cannot participate, and you have only employer contributions. Okay, that's good. Yeah, and in fact, a lot of oil and gas companies give you the choice when you sign up, Esther. They say, do you want it non-reg or do you want it DPSP or even sometimes TFSA? And people just, because they don't understand taxes, they don't think to make a choice there, right? So here's what you're going to see. So remember I talked about the group RRSP before, and I showed the group RRSP where I got this person making $50,000 a year and a 5% match. Okay, everybody remember that? Okay, yeah, I think most of us were to some extent, Esther. And we said, then the employee contributes their $2,500 and the employer matches that, the $2,500. And the result here was going to be that you've got $52,500 that's taxable, and then you've got $5,000 that's deductible, and you're paying tax on $47,500 of net income. And the taxable portion, and this is the really significant part of this, okay, the taxable portion is going to result in also CPP, EI, workers' comp premiums. They're all based on that amount. Okay, are we good there? Okay, so instead, I'm an employer and I don't have enough employees to set up a group defined contribution pension plan. You need probably around 450 or 500 lives in your shop to make that worthwhile. But even then, we see this used in some small or in some larger employers. For example, this is very common in the banks at their the front office staff or their sort of teller staff and that kind of thing. Okay, you see this. I think every one of the big 5 banks does this now for their tellers. Okay, We don't want to bring them onto the pension plan because it's onerous, and we don't want a group RSP for the reason I'm about to show you. So if I do a DPSP instead of the group RSP, here's what we're going to see. For this employee who makes $50,000, same deal. We're going to do the 5% match. The difference here is that we're going to match. So the employee uses the group RSP for their portion, but the employer uses the DPSP. Okay, everybody with me here? Okay, so now the employee, the $2,500 of employee contributions, that goes to the RSP, and that amount is tax deductible for the employee. Okay, but and this is where we're going to get the big change here. The $2,500 of employer contributions to the DPSP, it's not taxable to the employee. That's good. And it does not attract CPP or EI premiums, and workers' comp varies by province. Okay, so I wouldn't commit to a workers' comp answer there. That depends what province you're in. So maybe you don't think that's a lot of money, but if I'm the employer and I've got 400 employees who are in this category, or if you think about the banks, thousands of employees who are in this category, I'm saving 5.45% this year, my CPP premium, on all of those $2,500 is for every employee. Does that make sense? So that's where you're going to put that money into the DPSP instead. So here, your result is going to be much the same. The result is that the employee has $50,000 that's taxable, $2,500 that's deductible, $47,500 of net income. Okay, they did get $5,000 into, yeah, exactly that, Sean. Yeah, they got $5,000 into their group retirement, and they lost $5,000 of RSP room, or used, I guess, used is a better way to put it, $5,000 of RSP room, okay, which is the same thing we had up here. We had $5,000 into group retirement and $5,000 of used RSP room. Okay. And that's exactly what you're going to see here, Sean. You're going to see their retirement statement or their pension statement is going to break it down into their group RRSP and their DPSP. No, they still get a tax shelter, Sherry. The DPSP money is still invested for them. It's still growing on a tax deferred basis, right? Right, there's no, yeah, that's the idea, is it just never showed up in their income. But you see, it's the same net result in both cases, right? In both cases, that person is ahead $5,000, right? Or ahead $2,500, I guess, depending how you look at it. And they have that amount of money growing tax deferred. Okay, yes, that's true. So the employee does suffer a little bit because there's a little bit less income that's creating a CPP benefit for that person, but also at the same time, there's a little bit less income on which the employee has to pay CPP premium. That's also potentially attractive. Okay, that's good. It really is this type of workforce where you're most likely to see these DPSPs, okay? In workforces where we have people who earn income below YMPE. Remember, YMPE this year is $58,700. So that's where you're going to get your maximum savings from using the DPSP. If you've got a workforce where everybody earns more than $60,000, you're not getting a big savings out of using this plan. Well, in total, it's not into the DPSP, Melanie. Half of it is into DPSP and half of it is into RRSP, right? I have it, this $5,000 is the combined total, right? It's that amount. Sorry, try that again. It's that amount plus that amount, right? That gives me $5,000. Yeah, okay. Are there any questions there? Okay, now there are a couple of nitpicky points with this thing. One big benefit that employers like here is that funds can be locked in. Now, this varies a little bit from province to province, but essentially what you're going to see with DPSP is that if the employer puts money into the plan and the employee leaves in the first 2 years, the employer can take their money back. Okay, so we don't have to, sorry, it can be locked in and we can restrict vesting. I apologize. Okay, so we can restrict the employee from vesting until they're there for usually 2 years. Like I said, it does vary a little bit by province, but the employer can sort of insulate themselves a little bit from the risk of high turnover employees. Okay, that's good. All right. Just going to show one more thing with respect to the DPSP, and then we'll move into our pension presentation for the afternoon. So it's quite common. You see this actually a fair bit in the construction industry, that you're going to fund the DPSP with the employer's shares. So again, going back to that same thing I had a minute ago. Oh, I don't know if I can now that I started typing. Yeah, I guess I can. All right, I just don't have the same header. Okay, so, oh. Okay, so I'm going to, I've got the same situation. I've got my $50,000 earner. Okay, they put $2,500 into their group RSP. Okay, and the employer matches the $2,500 into the DPSP. However, this time we're going to do things a little differently than what I suggested when I looked at the group RSP a minute ago. We're going to use the employer's shares. Okay, and this is permissible within a DPSP. We can do this. The benefit here for the employer, what they like about this is there's no direct cash outlay. So they're just going to create new shares, issue those shares here. It becomes a true profit sharing arrangement where now the employees are incentivized to help grow the business. Okay, that's good. And what did I miss here? No direct cash, sorry, not outline, outlay, that should say. Okay. Now what that does mean is the employer has to have some buyback provision. And normally what you're going to see here is when the employees leave, then you're going to have a share valuation on departure so the employer can buy back those shares. Okay, does that make sense? Okay, and you do see this. This is common in the construction business. So PCL does this, for example. If anybody knows anybody at PCL, that's one example of a company that uses a structure, right? Well, this structure, okay? All right. Perfect. Can we be done with DPSPs then? No. So Robert, you could have, yeah, well, this is one of them, Sean. All right. You could do this for a privately held company, Robert. That's where you would need that share valuation, right? If it was a publicly traded company, then the share valuation is provided by the market. If it's a privately held company, then we'd have to actually have somebody value the shares annually, which is normal for companies that do this type of thing. Okay. All right. Okay, that's a good start for our day. Let's go on to the second half of the day. Okay, so we're going to use the financial calculator a little bit this afternoon. All good? Because we haven't used our financial calculator in a while. It's time, isn't it? Somebody looking for their financial calculator right now? Okay, so okay, so this afternoon we're going to look at pensions in general to start. Then we're going to go to define benefit pensions, which is where we're going to spend most of our time. Then define contribution pensions, which are really simple. Then pension unlocking, which is a fairly important concept, and time permitting, I'm not too fussy on this, we'll do PRPPs. Okay. So first off, RPPs in general. So as I mentioned this morning, RPPs predate RRSPs. Okay. Really, this is the original retirement or the original tax-favored retirement structure for Canadian employees. And the idea here is that the employer sets up a pension plan, and that pension plan is going to operate under the appropriate pension legislation. Now, every province has a bunch of different pension acts. Okay, legislation that covers pensions specifically. So, for example, in Alberta, we have, so Alberta has pension legislation for teachers. So the teachers legislation, the teachers have their own pension legislation. We also have our own pension legislation for civil servants or municipal and provincial employees, however you want to look at it. We have another bit of pension legislation for private companies that don't meet either of those descriptions. Okay. And then we also have pension legislation for, so they're going to fit under the civil servant legislation, Esther. You're right that they have their own separate pension, but it falls, in Alberta anyways, it falls under the civil servant pension legislation. Okay. And we have pension legislation for, well, how about MLAs, for example, okay? So the point here is you don't always get consistency. Now, Paul is right here So if you had an Alberta company that operates in, let's say, mining. Mining is a provincial industry under Section 91. Remember, we talked about Section 91 and Section 92 of the Constitution Act way back in Chapter 6. And everybody said, I don't care about Section 91 and Section 92, but here you care about them, okay? So if I have an Alberta company that operates in mining, it's provincially regulated. Their pension is provincially regulated. That's good. Whereas if I have an Alberta company that operates in aviation, where is aviation regulated? That's it. That falls under federal superannuation, okay? And superannuation is just a fancy word for pension, okay? That's good. So when you hear that word superannuation, it just means pension. That's it, okay? That's good. Anybody spend any time in Australia? Anybody ever live in Australia for any amount of time? No, if you do, you'll hear it sort of when ordinary people talk about saving for retirement, they talk about superannuation. That's the Australian term. They wouldn't talk about retirement income planning or whatever the case is. They would just talk about superannuation. All right. So often just figuring out what regulation governs your pension can be a headache. So this is going to be easy enough. If you live and work in Alberta, if you live, work, and retire in Alberta working for an Alberta company, okay, where it gets murky is if you live and work in Alberta for a company headquartered in BC. Okay, so now, depending on the circumstances, and this is something I don't have a good answer for, okay? Nobody does. Every situation is going to be different. You may fall under Alberta rules, or you may fall under BC rules. Okay, and there's a fairly complicated set of rules called the permanent establishment rules that are going to govern that. All right, does that make sense? And then when you retire, again, you may use the rules where your pension was built. That's most common. Okay, but there are some circumstances when you may use your local pension rules. And none of these answers are easy. And I'm sure some of you on the call have had this experience where to figure out how you're treating a particular pension, somebody actually has to pick up the phone and call the plan sponsor and ask them what set of rules applies. That's the solution, isn't it, Sean? Because, yeah, there's no way people are going to know this. Okay? Yeah, that's all you can do here, Todd, right? So you're never going to know until you have some clear information from the plan sponsor. Now, like I said, if you live, work, retire in Alberta, working for an Alberta company, fine, no problem. But as soon as we get any sort of more complicated iteration of that, this is where that falls apart. Okay. Yeah, that doesn't surprise me at all, Grant. I was just going to comment on that. I would make sure that the answer is a good answer. And a way to do that is to call back and talk to 2 or 3 different people, which seems like a dumb thing to have to do. But if you set it up wrong, as both Grant and Todd are indicating, it's very challenging to fix it. Okay. All right. 100% agreed, Bev. Yeah. That there are cases where, and you're in Saskatchewan, right, where it's often beneficial to have a pension based in Saskatchewan because you have the most generous unlocking rules. So sometimes, yeah, pushing the issue is going to get you a better answer. Okay. All right. Yeah, perfect, Grant, right? Now, what a nightmare that you still got a bad answer, okay? What a headache. Okay. I mean, that's probably true. Okay, so what does this impact? So why do we care about any of this? Well, it's going to affect our vesting rules. And vesting rules are when you have an employee leaving early, what rights do they have to the employer contributions? They're always going to get their own money back. The question isn't about their own money. The question is about employer contributions. So that varies. Oh, interesting, Paul. Huh. Okay. And they were living in New Brunswick at the time? It's interesting. All right. So, yeah, this Paul's example is a good example of one of these murky cases. Yeah. So we also have our unlocking rules that are going to show up here. And that is if you have locked in funds, that is LIF or LIRA money, can you move some or all to RSP or RIF? Okay, that's going to be influenced here. Oh, sorry, Paul. I knew you're in Nova Scotia. Yes. All right. Sorry about that. Okay. Okay. We did a New Brunswick example in class on yesterday, and it threw me off. All right. So, survivor benefits. Okay. And this is the question of who can be a survivor on the pension? What are their minimum rights? Okay, what other influence do they have? So these are going to be some of the issues we have. Oh, sorry. No, that's good. So these are going to be some of the issues we have to hammer out. And until we know, then we generally can't answer these questions. Now, in addition to pension legislation, we also get some influence from the Income Tax Act here. Okay, Section 147 of the Income Tax Act describes, or mostly describes, the operation of RPPs, registered pension plans, and that gives us some limitations as well as to what we can do with a pension plan. Okay. Any questions so far? So I point all of this out because as we work through the next couple hours of material, from time to time, you're going to ask me a question about what's possible, and I'm going to say, it depends. Okay. All right, I'm going to get rid of this slide. Okay, so then we're going to look at the defined benefit pension plan. It's the more complicated plan. It's where we have to put in more time. Okay. Yes, Grant, that's a good point. Uh-oh, this sounds like a painful lesson learned, Grant. But 100% spouses have rights, and I just referred to that briefly, but spouses have rights that have to be respected. And if those rights are not respected, you can really end up with a difficult to unwind problem. Okay, so yeah, although I've seen this go wrong too, Grant, with estranged spouses. Depending what province you're in, if you have somebody who is separated but not divorced, that's where you still have potential rights to a pension. Okay, those are lots of fun. You know, that woman you haven't seen in 15 years, well, it's time to divorce her, right? Those are super easy. Okay, so yeah, and often that's a legal requirement, Bev, yeah. Okay. So my defined benefit pension, here's what's going to happen. A typical structure for a DB, I'm pretty sure it's Amazon, Bev. All right, it can sit out there and wait. That's okay. So a typical structure for a defined benefit pension is, I'm always getting pizza at about 1:30 in the afternoon, Stephen. It's a perfect time for a giant pizza. Right. So typical structure for a DB is going to look something like this. We're going to take your years of service times a percentage times a formula based on income. Okay. And we're going to build the pension out like that. Now we'll start with the years of service. So this is the question of how long have you worked there? But there's also the question of how long have you participated in the pension? Okay, this can lead to two different numbers, two different inputs. So we can have what's called your eligible service and your credited service. Okay, and your eligible service, this is what's going to allow you to qualify to start receiving pension benefits. Whereas your credited service is going to help calculate the amount of pension you get. Okay, and it's not unusual that there is a 6-month or a half-year gap here. There's often a period where the employer says, we don't want to bring people onto the pension right away. We want to make sure they're going to stick around. So if we bring people on sort of on day one and they leave after 3 weeks, that's a giant headache. Instead, let's wait until somebody's here for 6 months and then we'll start their participation in the pension. And then we're less likely to have these headaches of people leaving really soon into their service. Okay. That's called a probation. Normally it's a probationary period, Todd. So we would normally just call that a probationary period. What's important for you and where you're going to see that is you're going to see the, on the pension statement, ultimately, you're going to see eligible service and credited service at different amounts, right? You're going to see a 6-month spread between those two. Yeah, that's true too, Paul. I shouldn't just say 6 months. 3 months is common enough by that, absolutely. Okay. It could be, Todd. Yeah, it could be exactly for that reason. Okay. And in fact, Melanie in the Tim and Melanie case study is going to have that. Okay. In Melanie's case, she's only getting a half a year of credit per year of service, but she's getting a full year of eligibility per year of service. Okay. Sorry, Melanie. All right. I at least spelled her name differently, Melanie. I can't change the case studies every time I get somebody sign up for the class. All right. Okay, you just have to hear the IE when I say her name, that's all. Okay. Yeah, that's a super long time, Sean, right? That is 3 years is a very long time. Okay. Yeah. Yeah, these are perfect examples. So what Sean and Todd are talking about, this really, I think, helps to reinforce that there's no one way this is going to work. Yeah. And in fact, you might never qualify if you're only part-time, Todd. You could easily have an employer who says only full-time employees participate in the pension. Okay. All right. Yeah, that's tough, Paul. I know most pensions today don't allow it, but occasionally you see that. And that's often a regret people have. You know, you've been working there for 20 years, opted out. That's a lot of money left on the table. Okay. That's probably good, Melanie. Yeah. All right. Okay. Now that honestly, going back to like Sean's case, Sean said 3 years. That 3 years is probably not a probationary period. That's maybe a qualifying period. So, and that's not universally the case. All right. But I understand what you're looking for there. Just be careful here, right? It's not, there's very few sort of universals. Okay. So then your percentage. And that would be again for that employer, right? That's just how they approach it, Todd, right? Okay, so percentage. This is going to be a maximum 2% of your income. Now, we're not using earned income here. We're using your employment income from this job, not earned income. Okay, so just for the sake of argument, let's go back to a similar situation to what we had this morning. I got somebody who earns $90,000, has a 2% pension benefit, which is not very common. I'll correct this in a minute, and pays $10,000 a year of spousal support. Okay, is everybody with me here? So even though their RRSP deduction limit is only going to be 90,000 times 18%, which is 16,002. Sorry, I apologize. The RSP deduction limit is going to be, let me fix that, $80,000 times 18%, right? We have to take into account their $10,000 of spousal support they're paying, which is $14,400. Okay, that's right. However, their pension benefit entitlement is going to be 90,000 times 2%. Is everybody with me here? Their pension is growing by $1,800 a year. Okay, so now when I do their PA, what was the PA formula? What did I have to do for the PA formula? So it's 1,800, yeah, that's X, yeah, times something minus 600. It was 1,800 times 9 minus $600. Okay, so their PA is going to be 1,800 times 9, that's going to be $16,200 minus 600. That's $15,600. Okay. So they're actually, their PA is larger than their RSP deduction limit. Does everybody agree with that? However, you can't go into an over contribution just because of PA. So they will lose their they will lose all their RSP room, but not in an over contribution situation, because their maximum participation in the pension is based on their income from their employment, not earned income. We don't have to worry about bringing your spousal support into your earned income calculation.
So you can over contribute this way and it's okay.
Kind of, yeah. It's just, it's a different, I mean, you have to have a defined benefit pension, and it's just that you're, I guess, breaking the RSP rules, but you're not breaking the pension rules. Okay. Okay.
Jason, can I ask you one other question about this?
Yeah.
So when someone just starts and they're 18 years of age and they're in a pension plan like this, there's some type of a rule that if they have no previous income, they're still able to put money into the pension plan. I can't remember what that rule is. Do you remember that? I know you know it. But in that first year of employment, you still get to put money into the pension plan, even though you never worked the previous year.
Right, because you're not using, the same thing happens for new Canadians. You're not using your last year's RSP deduction limit and I'll show you this in a few minutes, but when you have your RSP, and in fact, I should have done that properly on the RSP math slide earlier. When you have your RSP, yes, you're using the prior year's room, but for your pension, you're actually using the current year's income to calculate your room.
Okay, that's the rule around that. Okay, that's good.
Okay, yeah, to your question, Shade, this is not always clear, okay? And when I said employment income, what we don't know here and would have to be determined by the employment agreement would be, what about overtime? Does overtime kick in here? What about bonuses? Do we pay a pension based on bonuses? What about taxable benefits? Does our pension include taxable benefits? Those are all variable items that the pension can determine. Okay, it's a good question, Shay. Yeah, absolutely. Some pensions will bring all that stuff in. Some pensions say no. It's just based on your base salary. That's it. Okay, so I did touch on this earlier briefly, Robert. Let's have a look at that in a second. It's another good question, and I will answer it just in a minute here, okay? So just to go back to this formula, okay? What did I say is the maximum that your benefit can be for a defined benefit pension? What's the most that it can be? Sorry, you're close, Melanie, with the number, but on the screen here, you see a maximum. I show a max, okay, 2%. That's what I'm looking for, Philip, not a trick question. 2%, it's right on the screen, right? What is 2% times 9? That's 18%, right? So this is where the PA formula is designed to give you the same thing as the RSP deduction limit. Okay. All right. I told you I'd show you that, Esther. Good. So there is a reason for that times 9. Now, the minus 600 is designed for exactly the reason that I just addressed in Todd's question, because your pension room is always a year ahead of your RSP deduction limit. So we really have the $600 in there, which is a sort of assumed amount of inflation to make sure that PA and RSP room are roughly on the same page. No, it does not, Robert. So that's still always the formula, okay? Okay, now to your point, Melanie, and a couple of others, I think Shade 2, who else asked the question? Oh, Robert's question too. So remember I showed this morning that for 2020, your RSP deduction limit maximum was $27,230. Okay, everybody remember that? which correlates to, if I'm looking at an income level, I take that 27,230 divided by 18%, correlates to $150,000-ish of income. 151,278, in fact. So basically, if you make more than $151,278, then you're capped out on your RRSP deduction limit. That's right. And then for 2021, remember I pointed out that the limit here will be 27,830, and we can do the same math. That's going to correlate to about $154,000 of income. $154,611. Okay, is everybody with me here? Okay, so if I take that 154,611, that's the maximum income for my RRSP for 2021. Okay, so I'm going to take that 154,611. And once again, what's the most generous a defined benefit pension can be? The maximum percentage of my income? 2%. Okay, so I'm going to take that 154,611 times 2%. I'm going to get the most generous possible pension I can get. So I take that times 2%. I'm going to get $3,092. And that is the maximum that, and I guess it's actually with the 22 cents, I should include that. That is the maximum benefit entitlement for a defined benefit pension in 2020. Okay, that's the most my pension is allowed to grow by in 2020. Are we good there?
What is the growth? I'm kind of lost. The 3,092 is the
Right,
maximum benefit of entitlement.
So don't think about an investment return here. That really is your pension growing by that amount. So if I have somebody who earns, let's say $160,000
Okay.
a year for 30 years, okay, and has the most generous possible pension, okay, and there's no inflation. Okay. Ignoring any sort of inflation, because we never have inflation anyways, right? So I've got somebody who makes $160,000 a year for 30 years. Their pension, the most that their pension could be with no legislative changes, no inflation, no nothing, would be about $92,000. Okay. $92,767 of annual pension at retirement is the best they could possibly do. Okay. So it's not capital, Sean, don't think of it as capital. Everything with the pension, with the defined benefit pension, is built on the benefit. Okay, this is a concept we should be starting to hammer in. So I don't care about how much money is actually in the pension. I don't care what it cost. I don't care about investment returns. All I care about is the benefit. And it's right in the name. It is a defined benefit pension. Okay, that's good. Yeah, and that, Steve, would be paid to mortality. Okay. Are we good? So if you find yourself stumbling with a defined benefit pension, what are you always going to go back to? I don't care, Esther. It's irrelevant. You're not going to go back to the growth. Okay. I'm going to go to the benefits. That's it. Okay. Any defined benefit question, I'm always going to circle back to the benefit. And it's from there that I will be able to answer my question. Now, who does care about the investment returns here, Esther? So you live in Alberta. This has been a source of in the news a lot lately. Who does care about investment returns? The pension manager, but the plan member doesn't care. Okay. It's usually marked 2/3 or 75%. 50% is only true for, I think DND pensions are the only ones that do that. Okay. I don't really understand then, Robert. Sorry, I don't understand the difference between what I showed with my 27,230 and what you're asking. Your room carries forward. If you don't make your RSP contributions, Robert, your room carries forward.
Okay, and it never goes away.
That's true. Yeah.
Okay,
It did used to. It did used to. Prior to 1995, if I remember right, it used to only carry forward for 7 years.
Okay, thank you.
Yeah, thanks. Okay, so that's true, Stephen. If you had $100,000 of unused RSP room and you had some big taxable windfall this year and you decided to make a $100,000 RSP contribution, you sure could. Okay. Okay, so then we'll have a look at income. All right, everybody's with me here? So now there are 4. You could, Paul, could you do it? $27,000 a year. How many years would you have to work to get $1 million of RSP room? But I guess you could. Yeah, 53 years. Yeah. We have 4 income models for DB pensions. Oh no, it would be 37 years, wouldn't it? Isn't it 37 years? But anyways, yeah, you could. It's theoretically possible. All right, so my 4 income models, I'll start with the most generous. The most generous possible pension is going to pay based on your best earnings, and it's usually your best 3 of last 5 or your best 5-year last 10. Okay, and within that, it's usually consecutive. So we usually want your best 3 consecutive of your last 5 or your best 5 of your last 10. And this is really designed to help folks out who might take a sort of phased approach to retirement. Okay, so those best earnings plans, that's the sort of Cadillac pension calculation. All right, then I can have a final average calculation. Okay, so final average is going to take my last 3 or last 5. Now, with any of these, and actually I'll show this in a second, the income will be indexed. Okay, so you're always going to still index to inflation. It's really only the sort of performance component that's variable here, but you're always going to index these to inflation at the time that you make the calculation adjustments. Okay. Oh no, I shouldn't say that, sorry. It's only with the next one you're going to do that. I apologize. Let me fix that. Career average. This one's going to be indexed to inflation. Sorry, I'm not trying to confuse the issue here. All right, so career average will be indexed to inflation, and this is where you're going to take your whole career's earnings. Which sounds bad, but once you index it to inflation, it gets a lot better. Okay, and then what is a little bit more complicated, a little bit unconventional, but actually very common, is a flat benefit plan. And does anybody have a, or actually anybody on the call themselves who has a flat benefit plan? Former tradespeople on the call? I know you were, Bonnie, but I think you were for a corporation, not in a union, right? Well, Bonnie's not on the call anyways. What happened to Bonnie? All right. Bonnie used to be in the trades. Okay. So this is common in trade unions. For example, if you're a crane operator. So the crane operators union, their pension plan looks like this. They're going to pay you, you're going to have $150 per month as your pension benefit accrual. So let's say that this year I work 10 months on union jobs. So while I'm working those union jobs, the employer is paying my wage, or they're really paying the money to the union, right? The employer pays to the union pays my wage, my benefits come out of that, my pension is covered in the amount the employer pays, my union dues, that all shows up in there. One of the things that'll happen is there's a promise here then, if I worked 10 months, my pension grows by $1,500. That's my benefit entitlement for the year. Okay, and then let's say that I operate cranes for 30 years. At 10 months a year, I'm going to retire with a $15,000 annual pension benefit. That's good, and that's a very common formula or type of formula for trade unions, and you can see it's quite a bit different from the other two. Now, the sort of hours or months calculation is going to be different depending on the types of jobs you'll see. So crane operators tend to be on site for a month, 2 months, 3 months at a time. Nobody sets up a crane for 3 hours to do a big industrial job. That's fair? Oh yeah, sorry, 45,000. All right, that's a big difference, Shade. All right. You can tell it's not my pension, right? Okay, so when you look at other trade unions, for example, International Brotherhood of Electrical Workers, they don't do months-long jobs. Their jobs often are half a day or 3 or 4 days or that kind of thing. And their pension builds by an hourly rate. I can't remember exactly what it is, but it's something in the ballpark of $3 an hour. Okay, so every hour they're doing union jobs, their pension grows by something like $3. Okay, and again, this is all about the benefit. You see that? I'm not determining how much it costs. I'm not determining what the investment returns are. Nothing except the benefit. Okay. Are there any questions there? So nothing is guaranteed, right? Nothing is guaranteed.
I was just going to say, because I've had clients where they've gotten a defined benefit, but then it was reduced twice. Yep. Because the money that was in the plan was it was insufficient. It was not being handled properly. So
yeah, so I mean, Sears is a famous example of this, right? We just saw Sears go through this. Sears pensioners had this promise and then there wasn't enough money to meet it. So yeah, they often took a haircut of around 20 or 25% from their pension benefits. And it's not just Sears. So I talked about New Brunswick earlier. New Brunswick has sort of fought this pension battle. Mark, this was a fairly high profile thing. I can't remember who else is in New Brunswick, but fairly high profile, right? This would have been early 2000s. Wasn't it Bernard Lord? Do I have that right? Anyways, New Brunswick fought this battle, and employees, provincial employees in New Brunswick, are not getting exactly what they were promised. Their pension was supposed to be indexed to inflation, and now instead they're getting a sort of best efforts indexing on their benefits. Okay, so.
Yeah, I see that in a lot of pension plans that I've looked at and handled, where if the plans have changed from a DB pension to a defined contribution, a lot of the DB pensions end up becoming underfunded later on, and there's all kinds of problems, it looks like. So
Yeah, we've had,
I think there's going to be a lot going forward in the next 5 to 10 years.
It could be. I'm hesitant to guess at that. There is one province, and only one province, that has insurance for its pensions. If you're in Ontario and your pension sponsor goes broke, the Ontario Pension Insurance Program insures about $1,200 a month of pension benefits. Okay. All right, perfect. All right, are there other pension questions? Does everybody follow the basic idea here? I don't think so, Esther. I honestly think that there are ways to make defined benefit pensions work. Okay. I think that some of our promises are unrealistic. Okay. Now Bonnie's back. All right. Okay. Now, Esther, my opinion is worth as much as anybody else's opinion, right? Maybe less. So that's an opinion question, but I don't know. I've never seen anything that tells me that they should be scrapped. Okay. Yeah, there are ways to make them work though, Esther. Yeah. All right. You missed it, Bonnie. I gave my shout out to tradespeople and you weren't here. All right. Okay. It's like, where's our welder? Where's Bonnie? Okay. So now we're going to show a real life example. And there were a couple of questions that came up earlier that I have to address here. Yeah, we're going to talk about that later on, Mark. Yeah. Okay. So a true to life example of a defined benefit pension is going to look something like this. Let's say I have an employee who earns $80,000 a year. Okay, just to choose an amount. And this year, in 2020, YMPE is 58.7. Now, what's YMPE? Why do I care at all about YMPE? What's the relevance of YMPE? That's relevant for CPP. That's exactly it, Mark. That's the level of income up to which CPP benefits are paid. Okay. Year's maximum pensionable earnings, right? Okay. And this particular pension, and again, this is very normal, provides a promise, not a guarantee, but a promise of 1.4% of earnings up to YMPE, and then 2% of earnings over YMPE. Okay, and again, we would go to that maximum, not that it's going to be relevant for this person, but to a maximum of $3,092.22. Okay, won't matter for this person. We'll see that right away. So what's going to happen here their benefit accumulation or benefit entitlement for the year, or accrual, or accumulation, whatever language we use here, is going to be 58.7 times 1.4% plus 80,000 minus 58.7 times 2%. Okay. So 58.7 is $822. I know it's $180, but I don't care that much. $822. And the second part here is going to give us $426. So in total, this person's pension benefit will grow by $1,248 for each year of service. Again, completely ignoring inflation. Okay, so if this person retires, let's say with 35 years, which is a pretty common maximum, a lot of pension plans don't allow you to accrue a benefit anymore after 35 years. But if this person retires with 35 years of service, then they would have 35 years of credited service. Okay, so 35 credited years times $1,248. Okay, everybody's with me here? They would retire with a pension of $43,680. And again, paid to mortality. All right, that's good. That would be a nice pension, wouldn't it? That's a nice starting point for retirement income. Add in Canada Pension Plan and OAS in there. You've got about $60,000, $65,000 a year showing up that you don't even have to worry about. Okay. Yes, although that's very common, Paul, right? The 1.4% is a very common number. A lot of pension plans use a formula like this or very close to it. You'll see some that are 1.375% or some that are 1.3825%, always somewhere in that ballpark. Okay. Yeah, it can happen, Mark, right? You get people, and somebody who's a lifelong provincial employee, they often have a better lifestyle in retirement than they did while working. Yeah, absolutely. Okay. That's all good. They got the mortgage paid off, right? The kids are gone, all that kind of stuff. It is where I find we often overestimate what's needed for a decent retirement. Now, on the other side of that, if you didn't save anything, you can't overestimate that, right? Okay. If your pension happens to be indexed or even partially indexed, yeah, that can be a very beneficial calculation. Okay. Any questions here? Now, there is something else that's going to happen. This employee doesn't get this benefit for free. They've got to pay for it. So what does it cost the employee? Now, it's very common today. This used to be a lot different, but today it's very typical to cost, it's going to be a little bit more than that. Yeah, so it's going to cost typically somewhere around maybe 9% of salary up to YMPE, and then 11% in excess of YMPE. That's a very sort of ballpark number, but that's pretty common, somewhere in that sort of 10% range, give or take. These used to be a lot less expensive. Okay, so at one time, not even that long ago, but at one time we had non-contributory pensions. This is a thing of the past. So non-contributory pensions, the old Canadian Auto Workers pension before the 2008 credit crisis was a non-contributory pension, which meant employees didn't pay anything. Okay, none like that anymore. That's good, outside of very high earning executive compensation plans, but you just won't see this in a normal scenario anymore, okay? And then just maybe 10 or 15 years ago, it was very common to see something like maybe 4 or 5% up to YMPE, and then somewhere around 6 to 8% over YMPE. Okay. So most employers have gone back to their employees and said, hey folks, it's getting harder to generate the kinds of returns we need to generate. You've got to pony up a little bit more. Okay, does that all make sense? So your cost as an employee then, let's do the 9 and 11. That would be very typical today. So same type of calculation here, we would do 58.7 times 9%. Okay, and $21,300 times 11%. So this employee is going to have a payroll deduction here. $520, right? $528. And $234. Oh, sorry, something wrong here. I messed that up. I apologize. Back here, $5,283. Thanks, Sean. And that's going to be $2,130. Thanks. Yeah. Okay. I really tried to save this person some money, but you didn't want me to. So that's going to cost this person. So that's going to come off their paycheck. Oh, the 21.3. Oh, that's not right. Then I see. I thought you were doing something else for me here, Todd. That was the same number. That's 80,000 minus 58.7, just as Sean.
And no, I was confused at how did you come up with the 21.3?
Right, but yeah, Sean just gave it to you there, right? So
Oh.
It's the same thing we did in orange on the top right, 80,000 minus 58.7. That's 23.43. Okay. Okay. Yes, it should, Alicia. I thought Todd was giving me an answer there. All right. So yeah, that's, again, same thing, right? That's 80,000 minus YMPE. Okay, so we add those two numbers up. That's 52.83 and 23.43, 76.26, and that's just going to come right off the employee's paychecks to fund the plan. That's their contribution to the plan. Okay. That's going to be a tax deduction for the employee. So this is a direct cost off the paycheck, and that is a tax deduction for the employee. Okay, at line 23,800, if I remember right, maybe 23,900, but anyways, early in your set of deductions from income. Now, how much RRSP room do they lose? How would I figure out how much RRSP room they lose? That's it. I'm going to do the PA. The 7626 is now irrelevant. Okay. All I care about there is that that's real money this person has to spend and it's tax deductible. But even if there was a non-contributory plan, we would still do what Sean is indicating. We'd still do the PA. Okay, so we're going to do the pension adjustment. And what's my formula for the pension adjustment? That's it. Alicia, good stuff. We're going to do BE times 9 minus 600. Okay. So yeah, so if you remember the 2% times 9 gives you the 18%. That's kind of the gimmick there. I can't do anything else with it. Sorry. All right. I guess I could come up with a song about pension adjustments. Sean, maybe that's what I need. All right. So the benefit entitlement we saw was $1,248 times 9 minus 600. Okay. Look at everybody's got it hammered out there. All right, that's good. So I'll do 1248 times 9 minus 600. 10,630 benefit entitlement, Stephen. I have it in the, just on the left there. Immediately left the benefit of the BE. Okay, so that's going to be $10,632 of lost RRSP room. Okay. That's good. And remember that a PA can't put you offside. A PA by itself cannot create an overcontribution situation. Okay. Yeah, exactly. You can lose it all, but you can't overcontribute because of it.
So I got a question. So on the 1248, can that change, or is that standard sort of? I guess it depends on the percentages, right?
Yeah, it absolutely does. So if it was 1.375 and then 2, it would be slightly different, right?
Right, but it'll be always close to that. Okay.
It typically is. There are a small number of pensions. Cam asked this question earlier. There are a small number of pensions that use some other formula. So there's a pension I know in oil and gas country in central Alberta that does 1.5% across the board. Okay. Ryan, you might know folks at that company. I'm not sure. So you can see a 1.5, or you might see, very rare, but you might see a small number of pensions that give the 2% across the board. Okay. Yeah. Right. So every year, Bonnie, that calculation is going to happen. That's exactly right. I don't know if it's tricky, Todd. It's, well, I guess it's something you just have to pay attention for, right? You're not going to know until you see the benefits booklet, right?
Yeah, it's not, this isn't something we're going to do, I do every day, right? So.
No, and this is what I find happens.
That's the
very
problem.
common. I'm sure there's a few folks on the call who are like this. I know, Mark, you do a fair bit of pension work, don't you? I think I have that right. And you would have 4 or 5 pensions, I'm going to assume, where you kind of know the details of them. I find for people who do a lot of pension work, that tends to be what happens. And this ends up being very much a sort of water cooler thing, where if Mark gets good at Canada Post pensions, then every time a Canada Post person has a pension question, you know, they'll go in the lunchroom and ask around, and there'll be somebody that says, oh yeah, this guy Mark helped me out with my pension. That's what I very much find with pensions. It ends up being this kind of domino effect where once you've been able to help 3 or 4 people out with their problem, you get good enough at the pension that it just becomes this kind of, I don't know, this flywheel effect. Okay. You can estimate it, Sherry, and in fact, you're going to estimate it for case study, Melanie, all right? It is absolutely possible to do, all right? Yeah. Yeah, that's it, Mark, right? There's, you know, kind of the basics, and then it's just a matter of, oh, your income's a little different or your years of service are a little different, but once you get the hang of them, you know, and this is what I really do find this, that you're going to have a few pensions that you get good at. Okay. All right. That's good. So I'm going to assume that Mark is comfortable with this information, or probably has an easier time grasping it, just having seen enough pension stuff. Yeah, that's true. Okay. I think that's probably right, Mark. You might not know every last detail we've done here, but I'm sure that there's a lot of, I don't know, recognition bells going off here or whatever, right? Okay. So, yeah, and I don't really care about the math, Todd. I'm not showing you the math so that you can do the math over and over and over again. Although, to Sherry's comment, if you're going to calculate the benefit, yeah, you have to do the math. I really am showing you this because I find the numbers are the way to get to understand the concepts. I really have to be able to understand the difference between what it costs me to participate and the RRSP room that I lose by participating. Those are not the same number.
Yeah, it's good that you learn it. So
Yeah, I think you have to, yeah. Okay, we haven't even done bridging yet, Mark, okay? But yes, those can be quite important calculations as well. All right, so here's what we know so far. Okay, we've got an $80,000 earner. We've got YMPE at 58.7. We're 1.4% up to YMP and then 2%. We said it was a cost of 76.26. We said it was a $10,632 PA. We said a $1,248 benefit entitlement. And we said after 35 years, we were going to have a pension of $43,680 a year. Okay, is that a fair, that's a summary of everything we know to this point? Okay, yeah, that's a lot of numbers, right? Okay. I think, Melanie, sorry, I can't, I know what you're gonna ask me and I really messed that up. Sorry, you're gonna have to wait for the notes now if you need that one. Okay, so then, because I used the eraser, not the other thing. All right, good stuff. So then what we wanna look at here, well, actually, that's probably a good time for a break. Why don't we just take a break right there? You're pretty close, Sean, pretty close, yeah. Okay. Oh yeah, of course, that makes sense. Okay, let's take a break there. I've got 32 minutes past. Let's take a 15-minute break. And we'll resume then at, I guess that's 3 minutes to. No, that's not right. At 47 past, sorry. Some bad math. We'll resume at 47 minutes past. Okay, good, we'll see you back then, thanks.